The skill of saving money, a critical component of personal finance, is the subject of the discussion today. Well, that might not be the most sensible choice if you've ever imagined hiding your savings in a quirky ceramic pig with a silicone belly button stopper and an interior cash slot. Saving money can serve various purposes, from funding big expenses like a dream car or an exotic vacation to building a down payment for your future home. And of course, we must recognize the importance of setting aside funds for emergencies, because unexpected HVAC breakdowns don't exactly scream excitement, yet being prepared for them is essential. In this video, we'll delve into the worst places to save your money, aiming to prevent any potential financial setbacks. Additionally, I'll reveal the best place to save your money. The magical destination allows you to earn interest and guarantees easy access to your funds no matter what surprises life may bring. But before we proceed, hit that subscribe button and enable the notification bell, ensuring you never miss valuable knowledge. Let's discuss the 5 worst places to save your savings. Although we have categorized them from least risky to most unsafe, it's crucial to remember that they are all poor choices. The first unfavorable place to keep your savings is under the mattress. Aside from the discomfort it could cause your back, your emergency fund should provide peace of mind and not keep you awake. However, the main issue is physical cash, which doesn't interest you. Over time, this money loses value due to inflation, preventing it from reaching its full potential, much like the disappointing expectations for Ted Lasso Season 3. Remember, you can find better ways to manage your savings. It would be best to refrain from storing cash in places like your safe, on high shelves, beneath your mattress, or among your basketball cards. Large sums of money should be kept from home, as they may draw unwelcome attention and lead to theft. Although having some cash on hand in case of crises is a good idea, saving large quantities of money, such as $25,000, in case of a potential failure of a bank is not a good idea. The most sensible strategy would be to maintain at most $1,000 in cash at home. Let's get into second place. Your savings should not be kept in a traditional savings account. Perhaps at this moment, you're starting to question its rationale. After all, a savings account is specifically designed to save money. Banks want you to use it for savings, and they would be delighted if you do so, as it allows them to utilize your funds at a meager cost. However, traditional savings accounts provide very little interest, usually around 0.25%. To put it into perspective, for every $1,000 you save, you would only earn about $2.50 annually. It's indeed a pretty meager return on your savings. Having money tied to your checking account, which acts as a reserve or a modest emergency fund, is the main benefit of using a traditional savings account. If the need arises, you can effortlessly move money to your checking account thanks to this setup. The emergency fund should be kept from a conventional savings account. Even though it might yield more interest than simply stuffing money in a can, it's still not the best option for building your savings. The third location where you might want to avoid investing your money is in CDs. And no, we are not talking about portable discs or compact discs. We mean certificates of deposit. These are types of financial services provided by credit unions and banks where you can deposit your funds for a set period of time and receive an interest rate set up until the end of that period. The term of a CD can be anything from 3 months to 5 years in length, and they often offer a greater interest rate than money market or conventional savings accounts. But hold on, and there's more to consider. Even though it's funny to say, the phrase red tape has an unpleasant connotation. Most CDs have restricted liquidity, so you can't usually take the money without being charged a fee. Since having quick access to cash for unforeseen needs is the primary goal of an emergency fund, you would want that money to be highly liquid, like something you could sip via straw. So it's best to avoid putting your funds in CDs, mainly if they're intended for an emergency fund. The fourth place you shouldn't keep your money is permanent life insurance. These strategies have both a cash value savings feature and insurance for the insured individual for their life. Ultimately, they strive to fulfill two needs: insurance and savings. They often do poorly in both areas though. It's like a cousin of yours on Instagram who says in their bio to be a DJ and businessman but is simply jobless. It's easier and more truthful to tell things as they are. Indeed, you'll encounter the most common permanent life insurance policies of whole life, universal life, index universal, and variable life. Sadly, insurance agents posing as financial counselors frequently offer permanent life insurance. They might persuade you that it's a great way to increase your savings and build money. However, it's crucial to approach such assertion with caution. Permanent life insurance products can tie you down for many years, with hefty costs and significant commissions. A permanent life insurance policy's money value and insurance coverage may disappear if you discontinue paying the yearly fees. This could be very problematic if you're dependent on the insurance policy to save money or make investments. Additionally, with most permanent life insurance contracts, your family could not even get the cash value after you pass away. Your loved ones don't receive the full advantages they would have anticipated. Instead, it goes to the insurance provider. The fifth option that might not be suitable for everyone is investing in stocks. If you're looking to save money, you might refer to them as stocks, as that's the adult term for this type of investment. Probably the riskiest choice to take into account when it comes to protecting your funds is stock investing. Although potentially multiplying your hard-earned money through the stock market is tempting, we strongly advise against following this path. It may be similar to placing your money on top of your vehicle, storing it in a garbage can, or wrapping it in an envelope labeled "Destroy immediately." Investing in equities or mutual funds may be too hazardous for your savings account. The reason for this is that there's a chance you might have suffered losses on your assets when you have an emergency or need to save your money. For example, if your car breaks down and the mechanic tells you it will cost a lot of money to fix, you might need to sell some of your investments, possibly at a loss, to pay the bill. It is unnecessary to be proficient in Spanish to understand the negative aspects of this situation. It's critical to exercise caution regarding such hazards and think about safer solutions for your cash. Remember that your savings aim to prevent you from losing money, not to gain it, and that your emergency fund is not intended to make you wealthy. It is not an investment, it is insurance. It is a safety net to save you from re-entering debt in emergencies. Now that we are aware of poor places to invest your savings, where should you place your savings? I'll let you know where to put it. One of the best places to put your savings is a high-yield savings account. You might have come across this referred to as a high-yield savings account or HYSA. It's a specific type of savings account provided by banks and credit unions, offering significantly higher interest rates compared to traditional savings accounts. While typical savings accounts usually have an average interest rate of about 0.25%, high-yield savings accounts currently provide rates of at least 3 or 4%. That's a remarkable difference of 12 to 16 times more interest earnings. The most appealing aspect is that these accounts have minimal requirements or restrictions. Now, when considering these accounts, it's essential to find one that has no minimum initial deposit, no requirements for maintaining a minimum balance, and no penalties for withdrawing your funds. This way, you can say goodbye to bothersome fees and restrictions. However, keep in mind that you should pay attention to the transfer times and withdrawal limits associated with these account types. For instance, certain accounts may restrict you to making withdrawals only 6 times monthly. Usually, this isn't a significant concern because most people don't withdraw money frequently. If you face emergencies more than 6 times a month, it might indicate other underlying financial issues. A piece of friendly advice: it's crucial to make sure your high-yield savings account stays with a bank that is FDIC guaranteed, or if it's with a credit union, then make sure it's NUCA insured. Thanks to this vital step, you can have an additional peace of mind knowing that your money is safeguarded for up to $250,000 per investor, per bank, and ownership of account type. You might wonder how these high-yield savings accounts can offer such high interest rates. Internet banks provide the vast majority of them. Online banks can offer their customers better interest rates since they have lesser overhead costs than conventional brick-and-mortar banks. It's just as simple to start a high-yield savings account as it is to open a regular bank account, and the ease of use is astounding. The process is simple to complete from your mobile device, making it quick and hassle-free. The second best choice will be an account with the money market if you want a savings account that includes the advantages of a checking account. A money market account is a secure and reliable option to keep your money safe and sound. It typically offers a higher interest rate compared to regular savings accounts. Additionally, one of the advantages of a money market account is that it provides you with more accessibility to your funds through checks and debit cards. Similar to a high-yield savings account, when considering a money market account, it's important to choose one that is FDIC insured and comes with no fees, minimum deposit, and minimum balance requirements. While the interest rate may not be as high as in a high-yield savings account, the added benefits of checks and debit cards may be more valuable, making it a compelling option for your financial needs. Therefore, we recommend opening a high-interest savings account for your short-term savings accounts, sinking funds, and an emergency fund. It presents a fantastic opportunity for money growth through greater interest rates. If you're seeking another option, consider an account in the money market because it has the added advantage of being accessible via checks and debit cards. In the end, both of these funds can be helpful resources for accomplishing your financial objectives. Thanks for watching, and share this video with someone who needs a high-yield savings account in their financial plans. Until next time.